Gautam, good to have you on board now. As per the kind of estimates that we've got, a third of the Nifty 50 companies that have already declared their numbers, which is a total of about 66% of the Nifty companies by weightage, it's been a fairly strong performance despite a very challenging environment. How have you viewed the results so far?
Hi, good morning. So Nifty, so far 23 companies have declared the numbers, and numbers have been bang in line with expectations for this quarter. Whether you look at EBITDA or PBT or profit after tax, the numbers are by and large in line. What is important right now, and that is where I think the market's attention is getting more focused on, is the commentary for the next quarter. Because the visibility for FY22 has gotten impaired for reasons well known to all of us, given that we are in a very vicious second wave of COVID-19. And that is where I think market is concentrating more. Otherwise, for the quarter and for the year also, we have done fairly well. We might end the year with about 13-14% Nifty earnings growth, which will be the highest in a decade since FY11. So by and large, FY21 has passed on well, given what we were expecting about a year back. And there was panic all over, and there were expectations of a 15-20% earnings decline. Compared to that, when you look at April 21 as we stand today, we are doing fairly okay as far as FY21 is concerned. The question now is what happens to FY22, and that is becoming a little more, uncertain kind of a scenario.
Okay, so that's painting quite an optimistic picture despite all of the doom and gloom around us. And Gautam, if we were to nail it down to a sector in specific, the banking space, they've been resilient so far on their asset quality front in Q4. Most of them, have seen the they're managing to tide over in this quarter. What's the outlook over the next couple of quarters on the asset quality front, on the kind of provision figures that you're penciling in?
So banking sector has been fairly resilient, as you said. Specifically, the large cap banks, whether be it private sector banks or PSU banks like SBI, they've ended FY21 on a fairly strong note, I would say, with very good capital levels, PCRs ranging between 70 to 80%, and liquidity fairly strong. And overall, they might have ended the year on a very strong note, whether you look at ICICI or Axis or an HDFC Bank or a Kotak Bank. Commentary obviously is fairly cautious now, given the environment that we find ourselves in. But I think they are fairly well cushioned as far as balance sheet is concerned, if their provision levels are so strong. And I would expect that if things don't deteriorate very sharply from here, we might not see too much of a damage on the BFSI earnings, especially the large caps. And that is where we have our bias for almost a year now, where we've been recommending large private sector banks to be overweight. More bias within that towards the corporate-oriented banks like ICICI and Axis, where the room for valuation cushion was slightly higher compared to banks like HDFC Bank and Kotak Bank, which have been factoring a fairly strong stream of earnings. Yes, so overall, I would still think that in FY22 also, the banking and financial sector earnings, whether you look at it from a Nifty point of view or a broader market point of view, will still do fairly well. The underlying assumption, of course, being that we don't get into 3-4 months of a big national lockdown and things deteriorate sharply from here, over which we have very little visibility as of now, as I said in the beginning. But net banking sector, large cap banks seems to be doing fairly well, apart from the IT sector, of course, where the commentary has been fairly solid even in this quarter.
What about auto? Is that an area of concern, Gautam?
Absolutely. I mean, this is one sector where we think that the risk to the earnings estimate on the downside is the highest within our coverage universe. The fact is, there has been a prolonged lockdown now. It is extracting its own cost on operating leverage. And to compound the misery, there is an input cost inflation also that we have seen. And of course, we don't know where the volumes will come back, whether in May or June or July. This is a discretionary sector. And unlike last year, when there was a sharp pent-up demand that we saw post-September, October, possibility of that recurring is slightly lower in my view because people had savings last year. Some of that would have been exhausted. And given the uncertainty, it's quite natural for people to postpone a high ticket consumption item like a four-wheeler or a two-wheeler. So I would think this is one sector where one has to keep a very strong watch on the movement in earnings. I actually think that this has the highest earnings downgrade risk in our coverage universe. So therefore, when I look at our model portfolio in auto, we have names like M&M where the exposure to tractor and rural is slightly higher, and that is one segment where the relative damage is much lesser compared to say a two-wheeler, and that is what the commentary has been as well as monthly numbers have been showing. If you look at the numbers for April and also March.
Okay, Tata Steel reported a strong performance this time around, but is that something that's sustainable according to you? What do you think?
That's a tricky question, actually. So if you look at metal space as a whole, not just Tata Steel, one thing which is going on well for them is consistent increase in the commodity prices. In our coverage universe, this is one sector where our analysts had to raise his estimate 6 times in the last 6 months. And even today, when I look at the assumptions in our models, there is a cushion of almost 15% versus the spot prices. So if spot prices is 100 rupees, for example, the assumption in the model right now is 85. So there is a sufficient room for further earnings upgrade. And what is this commodity price increase has also done is it has cleaned up the balance sheet. You look at the deleveraging which has been underway over the last 9 months for names like Tata Steel, JSW Steel, JSPL, and even for that matter, Cell. So while the stocks have had a strong run up, the underlying commodity prices do make us believe that there is some more steam left. However, we are advising our clients to take some profits off here because in our global cyclical things, when they start looking too good, that is generally the time when you start taking off some amount of exposure. For us, it is an overweight in the model portfolio at the moment, and we prefer JSPL and Hindalco in ferrous and non-ferrous respectively, which are part of our model portfolio.
Okay, now the high input prices, Gautam, that's impacted margins of companies across the board. Do you think that this margin pressure is likely to continue? Do companies have pricing power? Because when we were talking to some of the corporates, they said that, they might not as yet pass on the price hikes to consumers and sort of bear this margin compression, because if in the FMCG place they were to do so, that would adversely affect demand. How are you looking at this overall scenario?
Absolutely, I concur with that view. In a normalized situation, typically I believe that for a well-managed consumer company with a strong brands and pricing power, raw material inflation is not something which I fret over too much. Because over a period of time, these consumer companies over the last 2-3 decades have shown us that they've been able to take care of margins through various cycles of commodity inflation and deflation. However, in today's scenario, given that there is a lockdown, restriction, and therefore there is an amount of pressure on volume growth, it's quite natural for the companies to be a little more guarded when they pass on the commodity prices. But some of the companies have shown even in this environment that they're able to manage volumes well. Look at Marico. Their, I think, volume growth in Saffola was more than 15%. And they've passed on price hikes of more than 30% in the last 6 months. So actually, this depends on sector to sector and company to company, which are the companies which have very good pricing power and who are not afraid to exercise those. But clearly, I mean, from a broader picture point of view, the risk to margin estimates clearly exist. And I would think as far as consumer companies are concerned, if those risks were to emanate, I would suggest to use that as a buying opportunity, because typically raw material pressures exhaust themselves on the upside or on the downside over a period of 1-2 quarters, because companies do find a way to manage that inflation. We have seen that over multiple cycles in the last 10 to 20 years.
Thanks very much, Gautam, for sharing with us your prognosis on the overall earnings season so far and what you're expecting as well.